Welcome back. The Monetary Authority of Singapore is looking to help insurance companies better manage risks with a proposed new corporate structure called a Protected Cell Company, or PCC. It aims to make complex insurance deals quicker and cheaper. The proposed law could take effect in 2028, strengthening Singapore's position as a regional risk management hub. Nasyrah Rohim with more.
Risks today are more complex and more connected and harder to price. A single disruption can cascade across multiple sectors and geographies.
Deputy Prime Minister Gan Kim Yong highlighted these concerns at an industry event last month. To drive further growth in the finance and insurance sector, he says new solutions are needed. That's why Singapore is offering an option to make alternative risk transfer solutions more accessible and affordable.
What's a Protected Cell Company, or PCC, and how does it work? Well, think of it like this container. A PCC is a single legal entity which separates its risk and assets into what's described as cells. So what this means is that if one part of the company gets into trouble, the others are left safe and unaffected.
Where this would help, this PCC framework would help, is to actually grow the captive insurance market in Singapore, to basically attract smaller companies who may not typically have the means, right, the resources or the economic justification to set up its own captive insurer, but now maybe leveraging off insurance manager who set up a captive and rent out cells, so that smaller companies can then have their own captive insurer that they can utilize.
Take, for instance, an insurance company that offers different policies for cars, homes, and travel. In a traditional corporate structure, all these assets sit in the same pool. So if there's a big spike in car accident claims, it puts the whole company's money at risk, including the other insurance policies. But with the PCC, the insurer keeps the money and risk for all these policies separate. If there's a big loss, it only affects one cell. And it's not just companies that benefit.
With climate change or natural disasters, the idea is the same. These are events that are highly uncertain, and therefore insurance companies have to find ways of being able to spread the risk across their different portfolio. So again, being able to isolate this risk under a certain cell structure or certain isolated structure then allows for this risk to be contained, and therefore the insurance companies will be more willing to undertake such funding. From the consumer point of view, that also helps. So if you think about, for example, food security, the fact that natural disasters may affect food production.
With this, it's hoped that Singapore can become a stronger financial hub by attracting more companies while keeping policyholders and investors safe.